Scott Bauer joins us, the CEO of Prosper Trading Academy. Scott, I know you haven't had a lot of time to look at this number, but I mean, when you look at the indices still in positive territory, considering the buildup into this one, I think you can take away that this one didn't ruffle the feathers of investors and traders, to say the least.
Boy, Ben, if Powell and the Fed could write a scenario, this would have been because they got a slightly better than expected number, which for the marketplace, the good news, bad news scenario, that's not a great thing. But for them, that's a good thing. But if you look at that wages component, which came down, and then I saw a headline, and you can confirm this, hopefully, looked like unemployment ticked up from 3.5 to 3.8.
It sure did. So it's at 3.8%. That's right. They were looking for 3.5. And then I'll add to that, Scott, it looks like last month's non-farm payrolls got revised slightly down to 157.
So this is all, and I really dislike this description. This is really the Goldilocks scenario for the Fed. This squarely puts them in place for no hike in September. Coming into the print, I think the CME Fed Watch futures were 89% of no hike in September. That's got to be, elevated probably closer to 100% right now. It was about 50-50 for November. I haven't seen what it is yet, but boy, given all of the eco data this week, and we were just chock full of eco data, most of it in line, most of it, maybe on the soft side. This is, I would say, for the Fed, for the markets, the cherry on top of what they wanted to see for this print.
Yeah, it seems like this month's not too hot. Again, 187, just above the 170 they were looking for. I like your attention being drawn to the uptick that we saw in terms of the unemployment rate, which again, as Scott pointed to, came in at 3.8% above the 3.5 we were looking for, as well as last month was at 3.5. The revision last month's down was not too cold, right, to where investors are getting concerned or worried about economic conditions. And as I look at the indices here, Scott, the reaction to, the S&Ps are basically 10 points above where we were headed into this number. I agree with you. It seems to be just right. But I guess the next question is here, what's going to bring about that next bid, that next round of buying ultimately? It seems like a best case scenario in terms of this number has been priced in. We haven't really moved higher in reaction to it, and it is just right.
Absolutely agreed with you, Ben. And coming into a holiday weekend makes that situation even more difficult. Okay. Because with the markets closed on Monday, we are absolutely going to see probably very muted trade, low volume after about 15 minutes after the market opens.
Everybody's headed on vacation.
So I think it'll be difficult for anybody that wants to take a position, a bullish or bearish position going into next week. I think that's going to be a difficult one. This is great news. It's a total reset come next week.
Yeah,
it really is. It is a total reset. It'll be 2 weeks until we get that Fed meeting. Earnings season is pretty much over. Will not really have started yet ahead of that Fed meeting here. So, it is really all bets are off, quite frankly. And as you said, what's going to be that impetus to maybe take us to that next level? I'm not sure what it is, to be quite honest with you, because, again, this week was just massive with eco data. We've got it all. It looks like it's priced in right now. And the Fed is probably smiling at this point.
Well, Scott, in many ways, as I take a look at this chart here real quick, one could argue that even if we were to hold this level, not see a lot of movement one way or the other, this is a big rally off the October lows from last year, 3,500 all the way up to 4,600, that high that we saw in July. Ultimately, a little consolidation in this area would be, in theory, healthy for the market if we could hold around 4,500, right? We don't necessarily need to rip into taking out those highs necessarily, as long as we can hold off these recent lows that we saw. Again, overlapping rotational price activity is a form of acceptance of a big move up like this here. Scott, you were just talking about, ultimately this move that we've seen higher, and it's not just the indices, right, that are up this morning. We're also keeping a close eye on crude oil higher here in the overnight session up to, 84.81. It's currently trading up on the day here by, what is it as I look, 1% right now at that level here in the middle of the $84 handle. That's going to attract some attention as well. Maybe not necessarily a headwind for stocks as long as it remains below some key resistance. But if we take that out, I'd imagine that could be a focal point next week if this ramp up we've seen continues.
And for the dollar as well. The dollar is held towards those recent highs, 103, high 103 area. We may see that come off a little bit. So, yeah, what is the market going to be focusing on? Sure. Gold, oil. I agree you. And I think, again, Ben, people are going to just have their positions. They're going to just take their positions off shortly after the market opens today. Holiday weekend, expect low volume. We get into next week. All bets are off. But you made a great point. The market should want to see that consolidation right now, up towards that upper end. That is a confirmation that this rally that we've seen over the last week and a half or so does have some legs. We don't want to see it spike up. That consolidation is a good thing.
Scott, we were just talking about that in the last segment, right? Upper, lower extremes here, and then the kind of that range-bound trade and what it means, what it tells us as traders. Talk to us quickly, speaking of range-bound type trade, maybe a scenario in terms of treasuries, yields kind of holding below those recent highs that we saw. I mean, that would be a very appeasing and kind of supportive of what we're just talking about in terms of the indices able to hold on to some of the gains we've seen off last fall's lows.
Sure, absolutely. And if you watch that 10-year, if that 10-year happens to break down below 4%, and I know that's just really a psychological number, but if it does, boy, that could be the impetus then to see that next move higher. Okay. Because it was just a few days ago, a week ago, that these yields were just seemingly going up every day. Now they've backed off. They're pretty much where they were at the beginning of the month. So if they dip any lower here, that could be the impetus.
Does seem like the takeaway here being whether you're talking yields, whether you're talking the U.S. dollar, crude even, one could argue at this just below this $85 level, nothing really here to create headwinds for the strength we've seen in terms of the stock rally. Very much, as you pointed to, Scott, a Goldilocks scenario. Scott Bauer, appreciate you sharing part of your Friday morning, a very busy Friday morning. Scott, thanks again. Scott's the CEO of Prosper Trading Academy.